Kumar.
Hi, Paula. Good evening. How are you?
Yeah, fine, thank you.
Yes, good. The cash flow, I sent you a little bit of a working for you. Did you get it?
I did, yes. There were a couple of items that I was a bit unsure on.
Okay.
It was on the finance lease.
Yeah.
Just the calculation and the carried down figure.
Okay.
They were different to what I calculated. I wasn't quite sure where that had come from.
Yeah. Can you tell me what are your issues like? Then this is what I send it to you. This is what I send it to you, no?
Yes, yes.
Yeah. Yeah. Any.
So the figure.
Yeah. Yeah. What are the areas that you had any issues, Fiona?
So the loans section, loans and leases. The opening figures at the beginning of the year, 600 plus 510. That was okay.
Yeah, because that is from the current liability component, and the non-current liability component we have to take both.
Yes, so I can see that. I can see where the new lease comes from, because that was in the question, but I obviously didn't pick that up. I missed that. So 2.55 million under new finance. So I can see where that came from. But the carried down figure 1476.
Yeah, that is again the both the things together.
Yeah, because I did add them together, but I had a different figure.
All right, okay, just finish to see whether what I have done. Or give me a second. This is the soft logic, no? Give me a second, I'll see what I have done. Closing figure 1476. Where did I get that one? Hold on for a second. Obligations under finance lease, non-current liability to 130. Obligations under finance lease to 850. I have made a mistake on the calculations. 1110. 550 minus 810. No, I think my closing figure should get changed. Yeah.
Okay.
Yeah, my closing with the answer 810 is all right, but I think I made a mistake in my closing figure.
Okay.
Closing
yeah, because that's what confused me. Because I thought,
yeah, right. Yeah, because the closing figure should be. I think I missed one figure there. The closing figure on the leasing should be 2850, 720 plus 2130. This is the figure we should get. Yeah, that's a mistake. Yeah, the figure should be 720 plus 2130, 2850.
Oh right, yeah, that's what I had. Yeah.
When you get that one, the balancing figure 810 is all right. But I have entered some wrong figure there.
Okay.
Yeah, 810 is the right figure for the balancing figure, which is the amount what you have paid as capital payment.
Oh yes, I can see that. Yeah. Okay.
Yeah, because
so that makes sense now.
yeah.
Yeah, so that's fine. And the other was just on the retained earnings. Actually, I can see where that has come from because that's the retained earnings figures changed to the P&L 3735. I think there's £300, which I'm assuming is the non-controlling interest element of that.
Retained earnings, there are two the retained earnings, the consolidated one is our 175 starting, and the P&L figure is the 3735. That is after the attribution, after splitting up what they got as the profit in the P&L. If you see the P&L, they say, as you go up on the P&L, attributable to non-controlling interest 300, attributable to owners of the parent 3735.
Oh, okay. I must have missed that bit as well.
That 4035 figure, profit for the year, should be split between the owners of the parent and the NCI. So, the P&L also gets split to retained earnings and to the NCI. That's how it came.
Yeah, that's fine. I just missed that then. Okay, so that's fine. Everything else makes sense. And I thought maybe I'd made a mistake on the...
I think on the share capital, no? Because the share capital, you have to be mindful, even though they have collected some 825 or something, what we have to find out is the share capital increase is how much, because they got 825, true enough, but it is getting splitted into two items. The share capital, they say 2,640,000 shares, and the nominal value is 25 cents.
Yeah.
So that one will give you a share capital increase of 660. So the balance 165 should go to the premium account.
Yeah, okay.
Actually, that one we could have, I worked it out on two separate columns. We could have easily worked it out on one column, share capital and share premium together.
Yeah, okay, yeah, and I had put the 825 underneath because I thought it needed deducting, but I wasn't sure. I know there's a couple of other queries, so I thought, well, I'll leave it as it is, and yeah, so I know to do that next time.
Right, yes. So I think you must go on practicing. Even if it's the same question, if you repeat it, still good, because you learn a lot by working on the question. Then you know exactly where to put, what to put, and all that kind of a thing.
Yeah, that's it. And then if I find an answer that I can't see where it's come from, I always find it helpful to work back and see where it is, because otherwise, you'd never know where you've gone wrong.
Exactly, that's right. And then when you, rather than doing sometimes many questions, even if you do the same question, you may be able to get the rhythm right, where to put the figures and how to lay out, and where to start and all that kind of a thing.
Yeah, okay.
Right. So today what I did was I sent you a exam question. It's all about the P&L.
Yes.
Marchand Group, I think it was June 14 paper, if I remember right. It's all about the P&L, because we had done a statement of financial position. We did a cash flow. So let's look at this P&L also.
Yeah.
So here again, what we have to remember in the P&L, if you remember, what we do is, if it's a subsidiary, we must add all the revenue, all the cost of sales, everything, expenses, everything must be added. Associate companies, no, we don't. Associate company revenue, nothing is added, but subsidiary, P&L, we add the revenue, we add the cost of sales, we add the expenditure, we add the tax, everything. Intercompany balances, intercompany sales, all must be completely eliminated, not only the unrealized proportion, the entire intercompany sales must be eliminated, both from the revenue and the cost of sales.
Okay.
Statement of financial position, we remove only the unrealized portion, unrealized profit. But P&L, we remove the total sales, total intercompany from the sales and the cost of sales. because one company sales is the other company's cost of sales. So therefore, in order to avoid duplication, we remove from both sides. Any unrealized profit we have, what we do is we add it to the cost of sales. That is to reduce the gross profit. That is what we do. Any unrealized profit we have, we add it to the cost of sales to reduce the gross profit. This is exactly the things what we do. So let's look at this question. Here we have I sent you a little bit of a note yesterday about the other comprehensive income and total comprehensive income.
You did, yes, I've read that.
Yeah, read that one carefully because it gives some very, very important things. It was actually one of your examiners who wrote that one, but it gives lot of details, and what I did was I highlighted some other things because there is no particular thing saying what should go to TCI, what should go to OCI, normal P&L, and it all depends on each of the relevant standards. IAS 21 deals with separate way, IAS 16 deals with another way, like that it deals with. So there's a little bit of a confusion at the moment, and they are reworking on this thing. So these are some of the ACCA areas which they may look at.
Yes. Okay.
So we have the revenue, we have the cost of sales, we have the gross profit, other income. Other income column, you have to be extremely careful because other income can be something arising from sale of various things, and also it can be due to dividend income, etc. So that's the area we have to be careful. Administrative costs, we don't have any big issues. Other expenses we should not have. Finance costs may have problems if there's an intercompany loan or something. Financing income also maybe because if there are any loans, then they are given the TCI all there. So let's look at the date of consolidation is 30th of April 2014. Statement of financial position, I told you, date of acquisition is important, date of reporting is important. In the P&L, more important date is the date of reporting. So here we are on 30th of April 2014. Because in a P&L we look at only for that year. So all what happened previously does not matter unless to calculate the goodwill for impairment or whatever. So following information relevant to the preparation of group statements. On 1st May 2012, Marchant acquired 60% of equity interest of Nathan, a public company. Purchase consideration comprised 80 million, identifiable. The fair value of the non-controlling interest was 45 million on 1st May 2012. So with that information, we can immediately calculate the goodwill. So as I said in ACCA questions, each little part you get marks. You must try and work as much as possible, little calculations. Every calculation gives you marks.
Yeah.
Marchant wishes to use the full goodwill method for acquisition for all acquisitions, right? The share capital and retained earnings was 25 and 65 and other components of equity were 6 million at the date of acquisition. Excess of the fair value of at the acquisition is due to a non-depreciable land. Goodwill has been impaired, tested annually, and as of 30th has reduced in value by 20%. However, 30th April, the impairment had reversed and goodwill was valued at 2 million above its original value. Now, this is a very, very nasty statement, interesting statement. Yeah. What we know, according to IFRS 3, goodwill, any impairment, we must identify, write it off. But we can never increase the goodwill. Right? We can never increase. So here what they say is they have increased the goodwill to 5 million. Because from 3 million written off and now they are going to plus 2 million. Goodwill was valued at above its original value. That means that's a bit of a nasty one.
Yeah.
So there you have to be extremely careful because the intangibles, internally generated intangibles cannot be raised up. Unless we have bought a bought something. So when we buy this company Nathan, only once we will have a goodwill, and that can never go up. So there is a wrong account in here. So that we need to understand. We need to reverse that one straight away. Right? Then Marchant disposed an 8% equity on 30th of April 2014. Yeah, in the year 30th of April 2014. So this year 8% of equity has got sold. So 60 was the original one.
Yes.
60, now 8. Now 8 gone. So it's a 52%, still it's a subsidiary. Still it's a subsidiary. So we have to consolidate, number one. Second one, when it's a subsidiary, the gain what we get on realizing that 8% is never considered a profit. It is considered as other components of equity. Right? It is a equity movement. If it's a subsidiary is sold, then it's a profit. But here it's never a profit. It should be other components of equity, any profit arising. So that you have to remember. 60 to 52%, still it's a subsidiary. So neither need to be consolidated. So that's something which you need to note in. Right? Then the carrying value assets, all that is given to calculate the gain. So that gain will be other components of equity, but not a profit. Now we have the other one, Marchant equals 60% in option a public limited company long time back, purchase consideration something. On 1st November 2013, Marchant disposed of 40% equity interest for a consideration. Now from 60 it is coming down to 20% during the year.
Yeah.
During the year, right? So it is coming down to 20%. So that means it is a disposal of a subsidiary. When it's a disposal of a subsidiary, we have to dispose everything, and finally if there's a profit or a loss, that must come to the P&L. So you can see the two treatments coming. One is a disposal, but still it's a subsidiary. In that case, the gain will give to the other components of equity. But here, the second one, subsidiary becoming less than a subsidiary, in that case, it should be treated as a profit. And they say remaining equity interest was fairly valued at 40. After the disposal, Marchant exerts significant influence. So that means with the 20%, the option will become our associate company.
Yes.
Associate company. For the first 6 months, it is a subsidiary. Second 6 months, it is an associate company.
Yeah, that's very tricky.
Very tricky, because these are very difficult to pick up unless we had done a similar question before. It's not easy to pick up that thing in the exam. First November 2013, during the year we have sold. Half of the year it's a subsidiary, half of the year it's a associate.
Yeah.
So when you are doing the P&L, you remember P&L, we consolidate the subsidiaries, we add the subsidiaries, but this being a half subsidiary or half year subsidiary, we take half of revenue, half of expenditure, all that half.
Yeah, and I guess the difference between the statement of financial position and the statement of profit or loss is with a statement of financial
position, if you have sold it halfway through, nothing will get consolidated.
No, so you haven't got
to P&L, because since it is a full year thing, because statement of financial payment prepares a date. So date on that particular date, if it's not a subsidiary, it will never come. But P&L, being a full year's operation, half year it was a subsidiary, and therefore we must include a half a year.
Yeah, okay. And if firm left with 20%.
Yeah.
If that sentence wasn't there saying that there was marchant exerts significant influence, if that wasn't there,
still 20 and over, the assumption is it will have a significant influence.
Okay.
20
Yeah.
and over.
So
if it has 19, then unless he says significant influence, then the assumption is it's a normal available for sale kind of investment.
So it's just an investment.
It's just an investment. If it was 19 or something. But 20, even if he has not said, it will be a significant influence. But sometimes, you remember last time we had a question more than 20, but they did not have significant influence.
No. Okay.
Expressly, they can say they don't have significant. But here, 20 and significant influence, that means it's an associate company.
Yeah. Okay.
So no impairment was required here. Then merchant sold inventory. Now this is a very tricky one. Merchant sold inventory to Nathan for 12 million at fair value. Merchant made a loss on the transaction of 2 million and still holds 8 million in the inventory at the year end. So 12 million intercompany sales we will definitely remove from sales and from cost of sales. Now what about, normally what we see is a intercompany profit, but here we have an intercompany loss. Intercompany profit, if there was intercompany profit, we will remove that intercompany profit by adding it to the cost of sales. This is a very tricky one. When you have intercompany loss, what do we do? What do we do? This is a very interesting one. The question is very, very clear, right? Sold inventory at fair value. Merchant made a loss of 2 million on the transfer. When something is transferred at a fair value and there's a loss, that means the loss is already absorbed.
So we don't change that.
You don't change that one, exactly. Right? This is a very, very tricky one. It would have been very, very difficult to pick it up. This is the funny side of ACC examiner. He puts all sorts of crazy things that you normally don't see reality in the thing. Because normally we have always an intercompany profit. If there's intercompany profit, we must take our proportion of that intercompany profit and add it to cost of sales. That's what we normally do, right? In fact, not our proportion, we take the entire cost of sales, entire unrealized profit and add it to the cost of sales. That's what normally we do. But here it's a loss. Loss, we don't deduct it from cost of sales, or we don't reduce the cost of sales. The reason being, when it is a loss and when they say it has been sold at fair value, loss is already absorbed. This type of thing is fantastic if you can put a note to the examiner and say no intercompany adjustment have been made for the 2 million loss because it is at fair value and it is already it is assumed that the loss is already absorbed.
Yes. Yeah. Okay.
So then we have been given a pension scheme thing. Let's keep that for a moment. We can do that one later on. Then we have been told about the property and plant and equipment, something about the revaluation. All these things are only affecting the parent company. So because of that, we can just wait for the moment. They are nothing to do with the consolidation. Then we have a share option scheme. It is also the parent company. Then we have a Nathan 3 million to be included in the subsidiaries for finance cost. Ignore taxation on these things. So thank God that he has told that one. Any expenses adjustments should be made in other expenses. So prepare a consolidated statement of profit and loss and other comprehensive income for the year ended 30th April 2014. So that is what we are supposed to.
Yeah, it's a lot to do in the time.
Yeah, I also noticed. I noticed a lot to do in the time because there are so many sections. For the 30 minutes we have about 30 marks, 45 minutes, lot to do within the 45 minutes.
Yes, you've got to really get to grips with the question and just get on with the calculations.
Kind of a question what we have to do is we have to have the practice of doing this kind of questions. So what I'm thinking is to pick up more questions and send it to you so you can go on practicing. You will make few mistakes, it's all right. But that way you will come to know the way to go ahead.
Yes. Yes.
So the first thing what I will do is I will try to put up a pro forma consolidated P&L. So the heading will be March End Group, Statement of Profit or Loss and Other Comprehensive Income for the year ended 30th April 2014.
Okay.
That's the heading. March End Group, Statement of Profit or Loss and Other Comprehensive Income for the year ended 30th April 2014. So we put the revenue, cost of sales, gross profit. Then we'll see other income, administrative costs, other expenses. We know there is an associate part of it, so we can put share of associate profit. Another line we can put it, because we know obviously there is an associate company here. So all that will give us the revenue minus cost of sales, gross profit, other income, administrative costs, other expenses and share of profit to associate company will give us the operating profit.
Okay.
Then we can, since we are given the finance cost and finance income separately, we can add finance income, deduct finance cost, and that will give us profit before tax. Then income tax, then profit for the year. Then other comprehensive income, there are a couple of things. So we will keep about 1, 2, 3 lines to include whatever there may be in the other comprehensive income. Then we come to total comprehensive income. Then we know in the consolidated P&L, the trickiest part is the profit we need to attribute between owners of the parent and non-controlling interest. So there are two apportionment. One, the profit for the year, that is before the other comprehensive income, profit for the year attributable to the owners of the parent and to non-controlling interest. Then we have to go and do the same thing to the total comprehensive income. Total comprehensive income attributable to owners of the parent and non-controlling interest.
Okay.
So that's my pro forma. Now having done that one, I will start with my working. So the easiest thing to do all these things is to have 4 columns. Merchant, Northern, option and a total column. Have 4 working columns. 4 columns to take every item, because that's the way to save time. So if I were doing this one, what I'll do is I will put up a working sheet with all the items.
Okay.
I'll do something like this. I will say merchant, Nathan, option, have an adjustment column also and a total column. Merchant, Nathan, option, adjustment column and a total column. So now I will start. Simply the parent revenue, I can straight away take 400 million, no adjustments there.
Yeah.
Nathan, I can take the 115. Option, I will take only half.
Yeah. Okay.
Right? Because option was a subsidy only for half of the year. So I will take 400, 115 and 35. And one adjustment, the total intercompany sales must be removed. So minus 12.
Yeah.
So I will put like this, 400 minus 12, which will give my consolidated revenue.
Yeah.
Why I'm doing this is because this is this every line collects some marks. So I will easy ones I will just go and put it up because I read the notes. I saw revenue is not affected by except the 12 million. Cost of sales 312, 65, 18 less 12. 312, 65, 18 less 12. How much is that?
383.
383. And that will give my gross profit.
Yeah.
Other income, we know there were certain adjustments. So I will not touch the other income for the moment. I will not touch, but administrative cost, I have no problem. I can just take the figures 15, 9 and 6. 59 and 6, which is 30. Other expenses, because therefore they said all the other things, all those pension funds, everything should be included on the other expenses. So I will leave it that for the moment. I will not do anything with that one. Right?
Okay.
Finance cost, no problem. I can just go and do 5, 6 and 2. I can put that figure also. Finance cost.
Yeah.
Finance income, I can put 6, 5 and 4. I can put it. I'm trying to, whatever I can fill, I'm going to fill it now.
Yeah.
Even if I don't have time, I have collected some marks as much as possible. Then income tax expenses, I can do the same thing, 19, 9 and 2.5. So those are the sure and short figures which I could have done it easily.
Yeah.
What I'll do is I'll look at the adjustments. Because first I saw some of the adjustments that need to be done. So now I will go and look at the adjustments what we need to be done. The first thing what we have to look at is that you remember the goodwill. What they said was that there was a on acquire 60% public purchase consideration, all that. Goodwill has been impaired annually and assets have reduced in value by 20%. However, the impairment goodwill had reversed and the goodwill was valued at 2 million above its original value. So we know that's a wrong entry, that what they have done. So we have to completely reverse it. So we have to find how much is the impairment of the goodwill. And for that purpose, we need to work out the goodwill in acquisition. Can you work out the goodwill in acquisition of Marchant and Nathan? Marchant and Nathan. Can you work out the goodwill on acquisition? To calculate what we need is the consideration, the non-controlling interest figure against the net assets.
Purchase consideration was 80 million.
80. Yes.
Yeah. And then the non-controlling interest, 45 million.
So 80 plus 45, 125.
Yeah.
The fair value of net assets acquired. Fair value of net assets acquired. How much? Read the note number 1.
Hang on, 110.
110, yes. Yes.
Yeah, it's you have to read it a few times to actually.
You have to read it, yes.
Yeah, it's so easy to pick up the wrong figure, isn't it?
Yeah, because because with all this kind of crowded figures, you might miss it. So you have to read it very carefully and get the right figure into your head. So 125 minus 110 will give us a goodwill on acquisition.
Yeah.
Goodwill in acquisition.
And then we need to adjust that.
Yeah, so goodwill in acquisition is 15 million. And what they say is it has been impaired long time back, right? And asset has reduced in value by 20%. So, as far as we are concerned, according to IFRS 3, the goodwill impairment will remain at 3 million. Goodwill impairment is 3 million. Now what they say, they have reversed that one and have valued the goodwill at 2 million above its original. So what they have done is they would have been internally generated goodwill working up to 5 million, and because of that they have wrongly credited the entry of 5 million to the P&L.
Yes.
Understand? So we have to remove that.
Yeah.
So we have to remove that 5 million. So if I was doing a work-in, I will remove that 5 million because that's not part of my goodwill. So as an impairment of goodwill, because original 3 million should have been there, right? And now what they have done is they have taken a 2 million. So in my work-ins, under the 4 columns what we worked, under margin, I will put a 5 million minus figure, goodwill impairment. Because what I did was, I had a 3 million minus figure last time because I got a 5 million internal. So you have to put a note saying, internally generated goodwills are not allowed to recognize, and therefore the entire 5 million need to be reversed out.
Yeah. Okay.
So under my workings under that 4 columns, under margin, I will put a 5 million minus figure.
Yes.
So that's my first adjustment that I will do as far as that goodwill matter is concerned. Right? So that's all right. Now I must calculate the gain, because what they have done is they have had a gain, and what have they done with the gain? Goodwill merchant disposed 8% interest. Accounted for the and had accounted for the gain or loss in other income. Now we know that is wrong. We can't consider it as other income. The reason being, because it's not a sale of a subsidiary. It's a change of the non-controlling interest. Earlier, we had 40% non-controlling interest. Now the non-controlling interest is going to 48%. If it is a full sale, we will definitely consider it's all right. So now we must calculate the gain what we have wrongly credited in the other income, because I have to remove that one.
Okay.
So to do that one, I know the gain on sale, but they say they sold it for 18 million. Consideration received 18 million. Now I must know what is the proportion of the net assets I sold on this day. So they say the carrying value of the investment in our books was 95 million on 30th of April 2014. Right? 95 million. 95 million for what is the percentage? 60%. Right?
Yeah.
The carrying value of the asset of 95 million for 60%. So 60% is worth 95. So I must show, I sold 8%, no? I must see the value of 8% what I sold. So 95 over 60 times 8. That will tell me the value of what I sold, or the net assets what I sold.
12.7.
12.7. So that is what I sold. So 18 million was the consideration I got. 12.7 is the what I transferred, or the NCI value I transferred. So there's a gain of 5.3. Right? But that 5.3, now what have they done? They have taken it under other income. Right? They are taking it under merchants other income. So in my working, under my merchants other income, already there is a figure of how much merchants other income. What is the figure of merchants other income?
Merchant 21.
21. So from 21, I know I need to remove 5.3. Because that is wrongly credited. So where should it go? Because that 5.3 should not be there because it's a change to the equity. It should have come in the balance sheet. So I can't take that as a credit to my P&L. Correct?
No.
So my 21 million figure should get reduced by 5.3.
Yeah.
That's it. So this is the way to go forward. Take one by one adjustments notes and try to do that one. So 5.3 I will do that one. Then look at the second one. Second one. We acquire 60% of equity. Now second one we don't need to work out the goodwill or anything because the second one, as far as we are concerned, there was it's a subsidiary. Sorry, we need to calculate the goodwill because it's not a subsidiary. We are going to dispose the subsidiary and we become a associate now. So we have to calculate the original goodwill because we have to dispose the goodwill also. So can you calculate the original goodwill when they acquired it on 30th of April 2012?
And this is option.
Yeah. Three figures we need the consideration, CI figure, and the net assets.
70.
Yeah.
Yep, 70. Non-controlling interest.
Yeah.
Uh, 28 million.
28, yes, correct. Then the fair value of identifiable net assets.
Okay, 86. Yeah, see, they do give you all the figures, but there's so many figures there, it's picking out which one it is you need.
Yeah, now that is why you have to be, when you are calculating goodwill, you must know what are the figures I need. When you are calculating the profit or loss, what are the figures I need. So when you are focused on those figures, you will only search for those figures. Otherwise, you will get mixed up with so many figures, and it's too much of figures for you to get out.
Yeah, and especially under the exam pressure, because it's a lot to do.
Yeah, definitely, it's not easy to read all these lines and to work it through.
Yeah. So that comes out to 12 million.
12 million. So at the beginning, we have a goodwill of 12 million. Now we are selling the subsidiary. So you have to remember, when we sell the subsidiary, we sell even the goodwill. So now we have to come to the point of sale, right? So when they sold the 40%, they got a consideration of 50 million. So when you are selling, what we need is, when you are buying, what we need is the consideration what we pay, NCI, and the fair value of asset. When we are selling, what we need is how much consideration we have got, what is the fair value of what is remaining with us, right? And what is the value of NCI? Because we get the consideration plus the fair value of what we retain plus that NCI is all our one. We have got advantage, other one we are getting rid of a burden, the NCI. So we have to add all those three. So what are the three figures we have to add? The fair value of consideration we got. 50 million.
The remaining equity.
40 million. and the NCI is
Yeah.
34 million. So 50.
Oh yes, yeah, 34 as well.
Right? So 50 plus 40 plus 34, 124. So we got a 50 million consideration. We have a 40 million worth of asset left over, and we are getting rid of a 34 million worth of a kind of a burden. And for all that, what are we surrendering? We are surrendering the goodwill of 12 million.
Yeah.
And also the 90 million worth of net assets. 90 million worth of net assets.
And when did the 90, oh okay, so the 90 million is given as well.
90 million was the net assets on the day of the sale. So we are getting, we got 124 and we are getting rid of our goodwill of 12 million and 90 million worth of net assets. So we are making a gain here.
So that leaves 22 million.
That's a 22 million gain.
Yeah.
And that's when the last sentence says no entries had been made in the financial statements of merchant for this transaction other than the cash receipt. So this 22 million, we must take it as other income now.
Okay.
That 22 million, we must take it as other income. So now if you go back.
The other thing is the share of profits, isn't it?
Yeah, because that is the profit on sale of subsidiary.
Yeah.
So now your other income, which was 21 million, will come down by 5.3 for the early adjustment and will go up by 22 million.
Okay.
21 will come down by 5.3, will go up by 22 million. That will be the merchant's other income for consolidation purposes.
Okay, yeah. Yeah.
Merchant's other income for how much is that figure? So I'm going on the 4 columns here. So on my first column under merchant, I will put 21 minus 5.3 plus 22.
Yeah. So that's 37.7.
37.7. Nathan, we don't have any problem because there were no adjustments there. So that 7 will come. And option, it's only half because we are a half company. So we are half. So our other income will be now 37.7 plus 7 plus 1.
Yeah, so 45.7.
Yeah, so now we have got the revenue, we got 538. Cost of sales, we got 383. And we got a goodwill figure, gross profit figure 155. And now we have got other income figure of 45.7. Administrative cost already have included 30. Okay?
Yeah.
Now we have to look at the other adjustments. So now we have actually basically done the big adjustments we have done. So now let's look at the first thing you wrote down, impairment of goodwill, that 5 million will be under merchant's column. Merchant's column. Yeah. Now I can immediately work out my associate company. You remember associate company for a half a year. So what is the profit after tax? After tax profit is 15 million. That is for the whole year. It was half a year associate company, 7.5 million. Correct? For the whole year, 15 million profit. For the half a year, it will be 7.5 million.
Yeah.
And 20% of that is our share. So I can put share of associate profit 1.5 million.
Okay.
So that also I can put it under merchant's column. Share of associate company profit 1.5 million.
Yeah.
So now my consolidated adjustments up to the P&L level is all right. So now let me go, but because since I prepared that my pro forma, I'm now going to the next item which I want to look at is the defined benefit plan. Number 5. So I have already dealt with my number 1, number 2, number 3, number 4 I have dealt. Now I take my number 4, defined benefit plan. So remember, the defined benefit plan we didn't do a theory session, but I'm sure you know that one. Now here at the beginning of the year, assets are 48 million, obligations are 50 million. So there is a minus, sorry, and obligations are more by 2 million. Right?
Yeah.
So we have to charge interest on that obligation. So our obligations is 2 million. So on the 2 million, we have to charge 10% interest. The net obligation is 2 million. On the 2 million, we have to charge to the P&L 10% of that, which is 9.2. 50 is our assets. Assets are 48. Obligations are 50. So net liability is 2 million at the beginning of the year. Remember IAS 19, we always charge interest on the beginning balance.
Yes.
So on the beginning balance 2 million, we will charge 0.2 interest. So that's my number 1, which will go to the P&L. Second one, service cost for the year ended 30th April, 4 million. That also will go to the P&L. Then the next one is the past service cost, 3 million.
Yeah.
So altogether, I have 7.2 million, which is coming up. And also they say remeasurement loss for the year ended 30th of April, another 2 million, which will go to the OCI because it's so 7.2 plus 2, 9.2 million I have to charge it. Right? 7.2 plus 2 million, 9.2 I have to charge it. So they have said something about what they do here. So they say something about the application of the IFRS 9, I think. Pension cost have not been accounted for in total comprehensive income, right? So the 9.2 million is the total figure. You remember always that what is coming up on the remeasurement, we have to put it on the OCI. So now you remember we had the OCI figure, no? Go down and under OCI, put under merchant 2 million remeasurement plan.
So that's being added because the assets are less than the obligation.
Exactly. No, not because of that one. At the end of the year, this is at the beginning.
Oh.
What we do is we take the net assets, the assets minus liability, the book figure against the remeasured value. If the remeasured value is, say, if it's a liability, net one is a liability. Let's assume the closing book figure net liability is 60 million and the remeasured value is 62 million. Then we consider that as a loss at the end. So we did not have to work that one. They have given the figure remeasured loss 2 million. We did not have to work that one. So this straight away goes to the OCI. Sometimes in the normal, if it was IAS 19 question, we have to work it out. So we might find the book is 62 million and the fair value is 64 million. So then it's a loss of 2 million if it's a liability. If it is asset, then it's a gain of 2 million. Because we always have to read at the fair value. So because of that, this 2 million will be recorded in the other comprehensive income as a loss. 7.2 million, we will charge it to the main P&L. 2 million remeasurement loss, we will show it on the bottom part. 7.2 million, we will charge it to the main P&L. So we will have a 7.2 million minus figure under main P&L under margin. We will have a 2 million under other comprehensive income under margin in the bottom column, bottom part in the 4 columns. So, correct?
Yeah.
Right. So we have now dealt with the 15, we have dealt with the other expenses, we have dealt with the impairment of goodwill, all that. So now one more item, property, plant area.
Okay, so sorry, that's a minus in the
Yeah, because altogether the
OC.
entire amount was 9.2 million to be charged. 7.2 million we will charge on top on the P&L part. 2 million we will charge it on the OCI part.
Yeah, okay.
Just for your information, that 0.2 interest we can even charge it to finance charges. That there's a provision to put that 0.2 interest even as finance charges, because that's a finance charge, or otherwise we can put it under net service cost 7.2 million. Whatever the way you want it, you can do that. Easy to put under net service cost, that one.
Yeah.
Now we come to the next one. It's all about the property, plant and equipment.
Okay.
First, it is an item of property, plant and equipment of 12 million, and this is being depreciated using straight line basis for over 10 years with a 0 residual value. At 30th April, asset was revalued to 13 million. So we originally bought the asset for 12 million. 12 million on 1st May 2012, and it was 10 years with no residual value. So every year it will be 1.2. So at the end of 30th May 2013 or at the end of 30th of April 2013, 1.2 would have gone up and it would have appeared at 10.8. Right?
Okay, yeah.
It was revalued to 13 million. So 10.8 figure went up to 13 million. So how much into the revaluation reserve? 2.2.
Yeah.
So now new figure is 13 million at the beginning of this year, and now 9 more years to go. So at the end of 30th of April 14, 13 million divided by 9 will be our depreciation, which is 1.44. So 13 minus 1.44, the asset should have a carrying down value of 11.56. But the value had dropped to 7 million.
Okay, yes, there's another adjustment then.
7 million. So there's a 4.56 million which we have to make an impairment. But although we have a 4.56 million, we don't need to take the entire 4.56 million to the P&L. The reason being, there's a 2.2 million revaluation reserve which came earlier.
Yeah.
So total impairment is 4.56, but because we have revalued it earlier for 2.2, we can set off that 2.2 and write off only the balance to the P&L.
Okay.
So these are the sharp adjustments what we need to know. So 2.36 million, we will charge it to the P&L. Right? 2.36 million, we will charge it to the P&L. And the revaluation adjustment 2.2 million will come to the bottom side, the bottom level under other comprehensive income. Other comprehensive income.
Okay.
So now if you see, we have in the top part we have the share of associate company 1.5, net service cost 7.2, property plant and equipment 2.36 there, and a 2.2 million at the bottom part. At the bottom part, correct?
Okay, yeah.
Right. So then what we have to look at is one more adjustment. That is what we call the share options. Shall we look at that one also before we finish? One by one we have to go. Now look at the share option 1. So on 1st May 2012, Marchand made an award of 8,000 share options to each of its 7 directors. Condition is that they must remain in employment for 3 years. Fair value of each option at the grant date was 100 and the fair value of each option at 30th April was 110. At 30th April, it was estimated 3 directors would leave before the end of the year. So you remember in share option scheme, every year we have to calculate the possible liability and the expenditure. So 1st May 2012 they gave it. So we are now on 30th of April 2013. But we have to first look at 30th of April. We are now on 30th of April 2014. We have to look at first on 30th of April 2013.
Yeah.
How many directors altogether in the company? They had 7 directors. And by this time,
7.
they thought 3 will leave. So they are not entitled for it.
So there's only 4 at the end of the year.
Yeah. So 4, we have to work out the total commitment. For 4 people, what is the commitment? 4 into 100, right? Each option is worth 100, the grant date. How many they get? 8,000. So 4 into 100 into 8,000.
Times 1 over 3 years.
That's correct. Times 1 over 3. Very good. Yes. Times 1 over 3. So that's the expenditure we would have charged to the P&L 2013.
$1.07.
1.07. Now can you work out for 2014 what is the scenario?
Okay, so it's so they've changed their mind.
Yeah.
At the end of 2014, there was only 1 director that had left.
Yeah.
Not.
Earlier we thought 3 fellows will leave, but now what we see is only 1 fellow is going to leave. So we have 6 directors.
So we've got to base that on 6 directors instead.
Yeah. 6 directors, correct.
1,000, and that's the second year, so 2 over 3.
6 directors. What is the multiplication factor?
Times 2 divided by 3. So that is 3.2. And then we need to deduct the 107.
Yeah, good. Very good. Very good. Very good.
2.13.
2.13 we have to charge it to the P&L this year, isn't it?
Yeah, it's very confusing under exam pressure to do a lot of this, isn't it? I think the first time I failed P2, I think I got 48%, and I was not expecting a P&L at all. It really threw me, and then I decided halfway through to go back and change some of my figures because I suddenly thought I had a completely different view on it, and I don't know whether I changed them. I didn't need to, I don't know, but I think it was just the pressure of the exam that made me doubt myself.
I know. I think that the only way I can think of is to do many papers.
Yes.
I think in your case what I see you know almost everything, like, so
I don't feel like I do though. I feel like the syllabus is so big, it's too much to remember.
Exactly. I think that is where the problem may be, because it's not only for you, it's all for all of us also. It's too much to work. But what I know is now you applied that 8 into 100, which is a fantastic one, because many people would have taken that 110 figure. But we know when it is Shah grants, we take the initial value. So you did that excellent, right? All those things are coming out very well. So we have a little bit more to do on this Nathan's 3 million, all that. So when we meet on, we are meeting on Tuesday, you know?
Yes, Tuesday next, 9 o'clock.
That's right. Tuesday when we meet, we will go to all that. This example I want to go to fairly detail with you. So we have another couple of parts also in this part. So we will do this whole thing again. But all what we have done up to this point, just put it on a paper, keep it up.
Yeah.
Just try, if you want, you can try the other things, but I'll go with you on this effective cash flow hedging and all that when we meet on Tuesday.
Okay.
Okay.
Yep.
Right. So
very much.
Yeah. So I'll see you on Tuesday at 9 o'clock.
Okay then. Thank you.
Thank you. Have a great day.
You too. Bye.
Bye. Bye.